Last week was a week like no other. There were concerns of potential widespread fallout from the collapse of US tech bank Silicon Valley, and it's safe to say it was a tense week in the markets. The European Central Bank then had to step up in the midst of all of this and deliver an interest rate decision off the back of a devastating slump in banking stocks. This really, to be honest, overshadowed the normal order of economic events as US PPI and retail sales both slowed dramatically month on month. To be honest, this is more evidence that the global slowdown is here. There is nowhere to hide right now, and this week looks to be one of the most volatile yet. Hello, I'm Connor Woods, market analyst at ForexSignals and howtotrade.com. Here is our weekly preview for the 20th to the 24th of March 2023. This is the 12th week of the calendar year, and it feels absolutely critical for the outlook of the markets for the next few months. That's because the Federal Reserve is set to deliver its next interest rate hike on Wednesday. After the banking chaos, the markets have priced 111 basis points worth of hikes in the next 6 months to 60 basis points worth of cuts. These are not moves that you see on a day-to-day basis. It's going to be crucial that you listen to the forward guidance on the path of hikes in the monetary policy statement and press conference. Will the Fed budge? After announcing on Thursday as well that the Swiss National Bank would provide a liquidity backdrop to a desperate Credit Suisse bank, the Swiss National Bank will also deliver its next monetary policy decision. On top of this, there is inflation data coming out of the UK, which is struggling at the moment with double-digit inflation still, a day before the Bank of England makes its interest rate decision. It is sure to be a wild week. So let's dive into the best opportunities with our expert analyst in the States, Shane Vernier.
Welcome to the 12th trading week of 2023. Now, this is Fed week, so typically on Monday, our Monday session is a sparsely populated economic calendar in both the United States and the UK. So we're going to focus towards that Asia-Pacific region, and we're going to be looking at the People's Bank of China and their interest rate decision. Now, the current loan prime rate in China is 3.65%. We're not really sure if the PBOC is going to cut rates or raise rates. They've been wildly inconsistent with their monetary policy, sort of marching to the beat of their own drum. So what I would say about the PBOC bank decision, that loan prime rate decision, is that it could bring volatility to everything from the Chinese yuan to the Chinese A50. So we're going to look at this China 50 CFD to open the week. I think this could be a key market for us as we get underway on that Monday session. Now, if you do take a look at the price action, we're going to a long-term area here, a monthly chart. Now, as far as this monthly chart, what jumps off the page to me is the double bottom that formed right around 2022's lows. You'll see that low value is right down around 11,150, somewhere in that vicinity, and that's the double bottom from last October and November. So I'm watching that area very closely. We're well above that. So if we're looking to actually make a trade, perhaps buy a deeper pullback, perhaps if the damage gets a little bit worse here in March, we may be able to buy a pullback in this A50 somewhere around 12,418. That's not a bad entry, and also 11,867. But first and foremost, I'm definitely hyper focused on that double bottom that's set up there towards last fall. And I think that if we do get some action out of the PBOC, you could see Chinese equities really move directionally. So watching that China A50 or the China 50 CFD for that Monday session. Now, Tuesday's a little bit different animal. We have a few more conventional market drivers here from North America, and it's really a big day for the loonie. It's a big day for the Canadian dollar. And we have a core CPI coming out of Canada, and we also have those retail sales figures coming out of Canada as well. Now, all eyes are going to be on the core CPI. Right now, inflation is first and foremost. It's the number one market driver in the world, aside from bank failures, but that's a long conversation in itself. But when we're talking CPI, we're talking inflation. That's going to affect the domestic currency. Doesn't really matter which country those numbers come out from. So Tuesday does mark release of Canadian core CPI. We're looking for this number maybe to come down just a little bit after the aggressive hawkish policy that we've seen out of the Bank of Canada for the past 12 months. So probably one of the pairs that I'm going to be hyper focused on there for that Tuesday session is going to be that Aussie CAD. Now, I always like trading the Aussie CAD because it's the true commodity pair. You got the Australian dollar, which is dependent really highly correlated to your copper, your iron ore, and your gold markets. And then you've got the Canadian dollar, which is highly correlated to WTI crude. Last week, we saw major bearish participation in WTI crude. Definitely had a major sway on that Canadian dollar. So for me, I'm looking at this weekly chart here on the dollar CAD, and just a few observations very quickly. You'll notice that we're very much in a non-committal technical area right between my moving average and my Bollinger midpoint. That signifies extremely tight trade, and typically markets that tighten up are looking to let off some pressure at some point. So for me, I'm going to be looking at this weekly chart, and I'm interested in that 2023, that January, that late January of 2023, that high, that spike high really is really the key, the high watermark not only for this year, but really over the last extended period going back into 2022. So what I'm looking to do here is potentially sell a retracement. Let's see if we do get an actual bullish move, perhaps something that may challenge that high. We're not even close to being there yet, but if we do get a pullback here, somewhere around 92 and a quarter, that 38%, that's pretty darn good topside resistance. And if we get a little bit deeper into this bearish move, if we get a nice pullback there, we're looking at about 93.50. So that could be a nice, robust topside resistance as well. Now, Wednesday's session really is, this is the Super Bowl. This is one of the biggest economic events that we've seen in a long time. Now, Fed meetings are always huge, but the Fed interest rate decision that's going to take place on Wednesday is one of the most uncertain outcomes, I would say, in recent memory, really in recent history. We had a pretty good idea throughout 2022 that we were going to get rate hikes at every meeting. And we had a pretty good idea that everybody on the FOMC were going to sign on to that. It was going to be unanimous decisions across the board. Now we're getting into sort of a gray area. Now with the failure of SVB Bank and the problems with Signature Bank and a few others, Credit Suisse, yet another one, you're going to see a little bit of a change in expectations towards what the Fed is supposed to do. Now, as of this video, there's about a 75% chance of a quarter point rate hike coming across the board for Wednesday. Now, that's changing seemingly by the minute. We saw tremendous fluctuations in that CME Fed Watch Index last week, and a lot of it had to do with bank failures and what the Fed was prepared to do from a rate and policy perspective to perhaps save a few of those fringe banks, maybe other banks that were in trouble as well. So going into Wednesday, we don't have much of a clue on what the Fed is going to do, but it's going to be hugely important that we see at least a little bit of tightening to the U.S. dollar, because if we don't, remember, those inflation levels are still very high, and the dollar could show some definite weakness coming off of what could be one of the first dovish beatings we've seen in quite some time. So this is the dollar index, and that's really we've been watching this market very, very closely, and it's an absolute perfect example of a range-bound market. And what we have right down here is the spike low, your low of January 2022, and then your high of 2022 that came across the board in September. Nice, beautiful, robust pullback late 2022. Now 2023 has been just an absolute rotational market. It really has been. Going back to January 1st, we seemingly cannot break from this 50% retracement of that 2022 range or the 62. So to the top side of this range, you'll notice 104.75 has been hugely important. We've traded it repeatedly over the last 90 days. And to the downside, that 62% retracement, 102.38, you'll notice that we've traded that really almost religiously over the past 60 days. So are we going to get a sell-off perhaps here in the USD if we see any dovish type of verbiage at all, if we see the Fed hold rates steady and not hike yet again to tackle that inflation, if the forward guidance from Jerome Powell and his tone in that press conference is sort of dovish and accommodative policy-wise in an attempt to really avert a financial crisis and keep the wheels on some banks that may be struggling, then you will see a weakened dollar. So we're sort of getting prepared for that. The bottom side of that range is 102.35. I think that could come into play, and if not, that top side, that 50%, 104.75 is also hugely important. Be sure to tune in. We'll have FOMC Live for you Wednesday afternoon. We'll cover all of Jay Powell's comments and some of the good price action of the day at that engagement. Now, the Thursday session is really a fascinating session because we have a tremendous amount going on. The central bankers get involved with the Fed on Wednesday. Will they extend their reach? They really ramp things up on Thursday when we have an engagement from the Swiss National Bank, the SNB, and also the Bank of England, the BOE. Both banks are supposed to get involved with their interest rate decisions. Now, the SNB sort of has a history of going rogue. Nobody really knows what happens in a Swiss National Bank meeting and what the final outcome could be. They have been known to do things on a surprise basis. So right now we're expecting Q1 SNB to hold rates right around 1%, hold them static at 1%. And then the BOE a bit later on in the session is expected to raise rates by a quarter point up to about 4.25 to really tackle that inflation that we're seeing in the UK. Now, the real question is will this robust price or will this robust policy, will this hawkish policy from the BOE bring on a recession in the UK? And more about that in a minute on Friday. So the pair that we're going to be focused on is the domestic currency of both of those central banks. We're going to be looking at the Great Britain pound against the Swiss franc. And what you'll notice about this pair, this is a weekly chart. It's been a very compressed type of a market direction, really a sideways market direction, compressed price action, really going back to that emergency BOE intervention, which was back in September of 2022. And if you remember that, when the BOE got involved in that gilts market and really sort of tried to put together, stitch together the UK's monetary system with a needle and thread, you'll see that is where the tremendous volatility came from. And we still haven't really challenged those lows. We still haven't really challenged that range the week of the 19th of September and the week of the 26th. So that is really a big zone. I think we could be in potentially for a breakout and a test of that if, in fact, we get a surprise out of the Swiss National Bank. So just looking at this as a real basic, technical outlook, I would go right back to my monthly. I understand that we're very compressed on the weekly, and you'll notice that your monthly chart, we've got some dojis in here. We got a hammer, we got an inverted hammer, we got a doji. It's really an interesting type of a dynamic. I would really work my Fibonacci retracements off of that September low, go right up to the subsequent periodic high, and take a good look at the key level in this market. And it's 110.50, 110.46, 38%. And this level's held up as robust support for what going on 1, 2, 3, 4, 5 months now. So that's a key level. If it in fact is taken out, we could see bearish price action take us down to maybe a deeper retracement, somewhere down around 107.10, maybe even 104.70 if we start getting into those panic type of conditions. Biggest thing to remember going into Thursday's session, be ready for anything from the Swiss National Bank. We don't know what's going to happen. That level right there in this pound Swissy, 110.50, that's a serious support level. If in fact it's challenged and taken out, be ready for a big time bearish move beneath that zone. All right, now we're going to wrap the week up again. We're going to stay in the UK and wrap the week up. Late week trade really is going to be defined by recession talk out of the UK. And what we have coming across the board is UK retail sales for February. We're expected to fall from a negative 5.1% to negative 5.5% on a year-over-year basis. So what that means is the situation sort of expected to go from bad to a little bit worse. That's going to really spark those recession talks in the UK. Now remember, the BOE last June, they were one of the first central banks to come out and say, listen, we're headed for a recession late 2022, early 2023. Well, these retail sales figures can give us an idea if that's exactly what's happening or if it's not what's happening. So at this point, we have to really take a look at that hard data and see exactly what the performance metrics, we have to kick the tires and see what those metrics are out of the UK before we make any really deep sweeping recessionary judgments. But what we will say is on a monthly basis, you've got this real deep pullback going back to that September low, and then you've got that all-time high right here in the UK 100, the FTSE 100, one of the more resilient equities indices, really a robust breakout over the past 6 months. And now March has been an extremely negative month. We've seen a pullback to that 50% zone and 62%, a nice support level down there at about 72.25. And we also have an additional indicator, that Bollinger midpoint, somewhere right in there is a fantastic area where we may be able to build a very nice position long if in fact we see either the BOE or retail sales send the FTSE a little bit further south. All right, that's all from here. We got a big week of trade. Just get ready for it. The coming 5 days are going to be fantastic, chock full of opportunities. So that's all from the Chart Lab. Let's send it back to Connor Woods.
Thanks, Shane. It is some week we have ahead of us, and this weekly preview has given you an insight into what to expect and what the best opportunities are. The event of the week will be the Federal Reserve interest rate decision, but it is just as, if not more, important to keep an eye on the developments coming out of the banking sector. Is the risk systematic or is it just a one-off? This week could go a long way in answering that million-dollar question. As always, our team of analysts will help guide you through these opportunities every single day in the trading room, ensuring a high quality service as we cover all of the events for you in our live streams. We'll help you make the most informed trading decisions and of course, be with you every step of the way. Until then, trade well and we'll see you on our next live stream.